Good afternoon, everyone. This is John Cortale, and thanks for joining our webinar today. We hope that you and your families are continuing to cope and that you're staying healthy and safe during these unprecedented times. We know that emotions are running high, especially given the uncertainty with the reopening of the country. I can tell you from a personal level, my anxiety level's higher with my 74-year-old dad playing golf every day now since the golf courses of South Florida are now open. The media certainly doesn't help matters as they continue to thrive off of negativity. CNBC is certainly a culprit of this. There's a running joke in our industry that CNBC actually stands for Constantly Negative Business Channel. Today, we have our strategic partner, Brian Marks, Regional Vice President of the Hartford Funds, speaking to us about the impact that the media has on people during times of panic and uncertainty. Brian, please take it away.
Thank you, John. Can you hear me okay?
Yes.
Can you hear me okay?
Yes, you sound great.
Okay, great.
Yes.
Okay, great. Well, I got the presentation up. So first of all, thank you for having me as a guest speaker on. Thanks for the time, everybody. I'll echo John's comments. You know, I live locally here in Maryland, and you know, certainly hope you and your families and loved ones are all staying safe and healthy, and you know, trying to navigate through some of these challenging times, both professionally, personally, you know, and mentally as well. So you know, we're just encouraging folks to be there for each other. So, you know, what John and I wanted to do on the presentation today was we have one here called Media Replay that I've been at Hartford Funds 17 years, and this presentation's been around for over a decade. It is certainly a timely presentation, but also really a timeless presentation, you know, based on what we're going through. So the format for today is I'm going to run through this presentation, maybe spend 15 or 20 minutes on the actual content. It's usually designed to be about a 45-minute presentation, so I'm not going to go slide by slide, but if you'd like a copy of the slides, John and his team have them, and you can certainly get those from him afterwards. And then we're going to just have a little bit of a Q&A session and talk a little bit more about some of the current things that are happening with the COVID-19 pandemic that we're in, and maybe more importantly, where we see some opportunities moving forward. So with that being said, I think just to start, you know, I always like to set the framework for this presentation by saying, you know, what we've experienced over the last 6 weeks in the financial market have truly been historical. We, from 2009 until February 19th, 2020, had experienced the longest bull market in the S&P 500's history, up over 300%, 11 years in history, or 11 years in tenure. And then on February 19th, we hit that high. You never know it at the time, but we then entered the fastest 10% correction in the history of the market. We then entered the fastest bear market, which is a 20% decline in the history of the market. Then we entered the fastest 30% decline in the history of the market from February 19th to March 23rd, dropping 34.5% in roughly over 22 trading days. Followed by the next day, March 24th, the single best day that the S&P 500's had since the Great Depression. And we're up 28% from the bottom on March 23rd. So we've had some really strong performance on the way back up. We're still 15% away from the high. So we'll talk about some of this in the current environment. But we at Hartford Funds have used this opportunity to look back and say, let's use history as a guide. We know how this story is going to end. The only thing we can't tell you is the date and time that will end. And what I mean by that is this is now the 21st time the S&P 500 has dropped by 20% or more. And to use a sports analogy, we're 20-0 and going back and setting new highs in the marketplace for the S&P 500. So we know it's a matter of when, not if. When we analyze some of these previous declines of 20% or more, the average decline was 36.5%. So as I mentioned, we fell 34.5%. So we're right around the average there. And then when we looked at it, actually the 1 year return from the market low of the S&P 500 on average is actually 41%. So let's hope that that continues for us in this recovery. Time will tell, but again, just using some history as a guide. Mark Twain has a famous quote that says, history doesn't repeat itself, but it oftentimes rhymes. So we want to look at that. And what we have in this presentation with media replay as I click through is, hopefully everyone can see the slides, is we use a little bit of fun here with the Time magazine covers, which we all, I'm sure, have read over the course of our lives at some point in time. But the top left-hand corner says economic meltdown. And you'll see 5 Time magazine covers here. And it says, now where are the jobs? Looking beyond the bear. The economy, is there light at the end of the tunnel? And if I click on the next slide, it drops the dates of these headlines and when these Time magazine were actually published. 1971, 1992, 2001, 1974. Some of these headlines literally could have been printed over the last 6 weeks or could be printed over the next 6 to 12 months. So we see that we've been through some of these challenging times before. The next one is so long retirement, and you'll see Social Security, 2 headlines. Will I ever be able to retire? In the bottom right-hand corner with stocks plummeting, why it's time to retire the 401k. And again, you'll see the dates pop up there where you'll see that none of these have happened recently, but certainly some headlines that we could relate to with what's happening. The next one is our system is broken. You'll see, again, this 5 headlines from Time magazine covers: medical costs, seeking the cure, one nation subsidized, the crash. And again, you're probably picking up on the theme that some of these headlines are very, some of them are current, 2018, but some are 1979, 87, 2012, et cetera. So again, using some of these as a guide. And here's the last one, which says debt, debt, and more debt. And certainly this is a relevant one with some of the government and fiscal packages that have happened that our country will have to deal with for the next 5, 10, 15 years. But you look at these, the debt bomb, the budget brawl, again, challenges that our country has faced. And again, I mentioned we've gone on and the market has corrected, had recessions, come back and set new highs every time. So we're 100% confident that this one will not be different. So we want to look at some of the history as a guide and see how we can use some of these as an opportunity. And the one thing we always encourage our investors, and John mentioned this on the front end, is oftentimes we've all been watching the news, we've been reading headlines. The last 6 weeks, the headlines have been nothing short of pretty much awful. And we always encourage our investors that it is extremely rare to have attractive stock prices and very positive headlines. So oftentimes when the headlines are the worst is a great opportunity for the long-term investor to buy into great either equities, fixed income, mutual funds that might take advantage of that and hold them for the long term and experience the benefits. But it can be really difficult to get past some of the short-term noise. So we at Hartford Funds, again, this is a 45-minute presentation that I'm going to condense into a shorter period of time and hit some of my favorite slides. We talk a little bit about the presentation, anxiety, mistakes, solutions, and really kind of bucket it into 3 areas. The first being anxiety, and John mentioned it. It's certainly a lot of anxiety with what's happening, the virus, how long, does the virus live? How does it get transmitted? Testing, reopening now. Certainly, I'm not a doctor, but there is a lot of anxiety and questions that investors have. So the first one we want to tackle here is a couple slides. So this says the daily media storm. Adults 38 and older watch 30,103 minutes of news a year. And it should say actually consume 30,103 minutes, because we're not always watching them on the TV or listening to them in the car. You might be listening here, holding your smartphone. You might be watching this on your smartphone. The ability to access information has never been higher, and the media knows this. So if you actually divide 30,103 minutes into 60, that's 503 hours of news coverage people are watching on an annual basis. So we want to know, what are they hearing out there, especially from an economic and financial perspective. So this is a survey. You can see the data source on the bottom, but we looked at and said, until a few years ago, Americans viewed our economy as mostly bad. So this was a simple scatter plot of when folks were asked, economic conditions in this country are ... Either folks answered fair, poor, excellent, or good. And in 2014, you only had 19% of people saying excellent or good, 80% saying fair or poor. And again, I looked down, 2016, that number goes to 68%. And in 2017, it's still 60% of people thinking fair or poor. And again, I remind you the comment I made in the beginning, from 2009 to 2020, we had an 11-year bull market, the greatest bull market that we've seen in our history. And you still had folks 8 years into that recovery saying that the news and the economy was in really poor or fair situation. Not only that, it finally inverted where we had at least 50% of the people in 2018 and 2019. So again, we at Hartford Funds, we want our clients and our investors working with the advisors like John to be informed, but we also want to make sure that we give them information that we think is relevant to them and their financial situations. I always encourage folks, if you're a client of John's or maybe you're a friend or somebody listening in, nobody on the media or CNBC knows your personal situation. They might be talking about this is a good opportunity to invest in, but they have no idea if you're 75 or you're 45, if you are in retirement, if you have a pension, if you don't have a pension, are you taking Social Security? Do you still have a mortgage? So many different variables from a planning perspective that really, only a financial advisor and his team can really understand and then make suitable recommendations on what makes sense to them, to you all as investors and folks that John's working with. So the next thing I'm going to skip through. This is just a heat map showing the word anxiety being Googled, as you can see, as technology and some of the recent headlines have picked up in the access to information. The dark blue is pretty much all across the country. So again, the media knows this, and this brings me to one of the charts here that I think would be one of my first takeaways and one of my favorite charts here in the presentation. So this is showing the S&P 500 kind of on that TV screen that we're showing here, which is in light blue, and then the red line, which is CNBC viewership over a 10-year period, 2004 to 2014. And what you'll see is there's pretty much an inverse relationship between how the market is performing and how much CNBC's viewership is watched. And again, it comes to no surprise to John and I in the financial industry is when things are poor, people or the market's declining or there's a lot of volatility like now, or the negative headlines are out there, people tend to tune in. And then when the market begins to recover and move on and set new highs or just begin to recover, you can see people tend to tune out. And I don't want to say they don't want to focus on this because it's not important, but they tend to focus on the next crisis or maybe more personal things like grandkids, family, vacation, sporting events, things that they need to have from a commitment standpoint, knowing that things are recovering and things are doing well. And so they kind of turn their focus and attention to that. So the media needs to continue to always sensationalize and drive folks to try and drive the ratings higher while still trying to provide relevant news. It comes as no surprise to us at Hartford Funds that actually on this chart here, September 29th, 2008, during the global financial crisis, was the worst single-day decline in the market since the 1987 crash, and CNBC had their best single-day viewership that they've ever had. So again, keep that in perspective there as you continue to watch what's happening. Again, we want our clients to be informed, but why we're doing webinars like this and why John's offering a series of these is we want to provide relevant information that we think can really help our investors with things that matter most. The next thing that I want to hit on, I'm skipping through a few slides, is this risk aversion. So this is, again, one of my favorite slides in the presentation. This is just showing the S&P 500 from 1926 to 2019. And so we have almost 100 years of history for this. And really, all it's showing in the chart is there's a 0 in the middle of the screen on the left, and then a line going across it. And all it is calendar year returns from January 1st to December 31st. If it's green, that means you made money for the year. If it's red and below the line, that means that the stock market was negative for that calendar year. And hopefully you'll see what I see on the screen is there's a heck of a lot more green than there is red. And if we actually look at it on an annual basis and say, okay, how many times was the S&P 500 positive in that time period? And the number is actually 69 positive years going back to the history of the S&P 500. The number of negative years, 25. So you literally have 74% of the years being positive and 26% of the years being negative. So when we take that a step further, that average annual return is over 10%, which I think any of us on the phone would love to book 10% for our investments. And the number of years where those gains were greater than 20% for the green was actually 35 of the 69. So over half of the years when the market was positive, it was up over 20%. The number of years when the losses were greater than 20% on those red lines was actually only 6. So again, focus more on the positive than the negative, and see this really as an opportunity. And it says it's the fear of loss blinding you from growth opportunities. We would encourage investors to think long term. That is always difficult to do, especially difficult in the environment that we're in right now, and especially difficult if you watch a lot of media and headlines because you're going to be scared to death and not do anything, or at least most folks. But when we think about this and we say, okay, let's apply this percentage of positive year returns to a 10-year time period. So we would, Hartford Funds would say a 10-year time period is a long-term investment horizon and a really good period of time to evaluate an investment. And if I shared with you 74% of the years were positive, which they were on a calendar year basis, then we know if we own equities over a 10-year period, just based on the law of averages, we're going to have 2 or 3 years where we're not in love with what's happening in our portfolio. You know, our investments might be down. We remembered our value was at this, and now our value is less than that. When will that get back? And again, that's where the emotion kicks into it. Greed really run our investing minds, and we want to try and, sideline those as much as we can. But again, this is really the price that we need to pay, or really the expectations we should be really, really comfortable with to get that 10% plus rate of return over a long period of time. There's a reason why CDs are paying less than 1% and fixed incomes in the 2 or 3% range historically. It's because you don't have the upside potential that the market does. To get that, you do need to experience some swings in the account values, but over the longer periods of time, investors who have stayed the course have certainly benefited from owning equities over the long term. So again, hopefully this year-by-year chart sheds a little bit of perspective on, the expectations for equity returns over, the long term. And again, I always encourage investors to think about it in those 10-year windows, 7 or 8 years positive, 2 negative, or 3 negative. We certainly got a lot more to be happy about than to be disappointed about. Next slide is just showing a couple of the previous recessions that we've experienced, working from the right-hand side all the way to the left. The most recent was the global financial crisis at negative 50%, the 2002, 33, 2000, 2001, negative 35. And you'll see a couple bullet points on what caused those. And again, we just put this in there from a perspective standpoint, where you've had other times like this, where we've experienced some of these downturns that I mentioned on the beginning. And again, that we've come back and recovered from all of them. I think here's the last chart I'll hit on before we maybe jump into some of the question and answer piece of it. This is a really good picture here of a long-term view of the S&P 500. So we go back 50 years for this, and we look at this as an equity investor is in that navy blue, dark blue line. All of these investors, all the 5 different colors, start with $10,000. And you might say, geez, 50 years, that's a really long period of time. I don't have a 50-year investment time horizon. Well, we at Hartford Funds work with the MIT Age Lab around a lot of longevity, consumer behavior, research on how people are using technology, retirement trends. And right now, if John had a meeting today with a 65-year-old couple, a brand new client coming in to work with him, there's a 63% chance that one makes it to age 90 and a 36% chance that one makes it to 95. So we're talking 30 plus years. And unless you have an extremely large balance and very minimal debt, most folks in retirement still need to own some kind of equities. So again, we want to talk about looking at this as an opportunity to understand more about how they work over the long term. So on here, you see equity investor navy blue, $10,000 grew to $1.4 million, which is great. If you can ride the storm and not sell out at the bottom and you can capture that upside, it's certainly the best way to go. You might need some hand holding along the way. But the next one to look at is the light blue investor, which is the balanced investor. And that is someone that is just 50% in stocks and 50% in bonds. And you'll see they certainly didn't get all the upside, but they really had a nice rate of return and a nice experience along the way over that time period. The line we always highlight is that red line, the reactionary line. And this reactionary investor is really what we want folks not to do. This reactionary investor is somebody who's 100% in stocks or in the S&P 500, and then every time the market drops by 30% or more, which you can see on here, there's kind of 5 of those, easy buttons, if you will. And on the previous slide, it actually highlighted what those 5 downturns were. But every time the market dropped by 30% or more, that investor moved into 90-day treasury bills, which is basically a cash-like investment, said, hey, the headlines are really bad. I want to go into preservation mode. I just want to protect what I have. And they wait 2 years to come back into the market till it feels better and the dust settles. And what you can see there is that by doing that approach, that investor literally had half of the returns of being 100% in equities and significantly underperformed just being in a balanced portfolio and kind of riding out the good and the bad times together. So it is extremely difficult to time the market. If this chart went out to the end of the first quarter in March, we'd have another 30% drop button in there. So that client would have missed some of the rebound that's happened already. As I mentioned, we're up 26% since the March 23rd lows, still about 15% to get back to the February all-time highs. But we've certainly made some really good progress. And the number one mistake we see investors making is selling quality investments based on short-term volatility. So that's where John and his team can really, communicate and make sure clients aren't making a short-term decision on an investment based on when they still have long-term portfolio objectives that they're trying to accomplish for them and their family. So again, I think I'll pause here, John, and maybe I'll turn it back to you for the question and answer piece of the presentation.
Yeah, Brian, that was some really good stuff. I've been getting some questions from clients recently that I'd like to get your perspective on. The
Sure.
first question, what are your thoughts about the government pumping so much money into the U.S. economy? Do you see inflation coming? How about the demand for the dollar? And what about the long-term effects this all will have on the economy?
Yeah, so that's certainly a question that's on a lot of investors' minds. I'll try and take them piece by piece. So government pumping so much money in, do we see inflation coming? In the short term, the answer is no. If anything, we see potential risks more for deflation than inflation, although we don't think that will probably materialize. But none of the money that the government is pumping into the system is being used to push the price of goods up, and unemployment, is going down, or actually I should say going up. Unemployment is going up. So consumers have limited to no access to purchasing power. So every time the Fed pumps money in, we all get fearful that inflation is going to happen, but oftentimes it never materializes. We can use the 2008 time period again as a piece of history as a guide where a lot of money was pumped in, and we never really saw the inflation pick up over that 10 or 11-year period. Next question was on the dollar, right? Your demand for the dollar?
Yeah. Yes, absolutely.
Okay.
What's your feelings on that?
So you know, I'll answer that two parts. Short term is right now it's still the safety currency, and so there we see the demand for the dollar continuing to be high as we remain in volatile times. You know, really until we get the public health situation under control. But it will likely go down as the global economy bottoms and starts recovering, as well as uncertainty falling. It'll lose its safe haven status, still remain strong, but probably trend down a little bit. And that's not because the U.S. will get weaker. We just think other countries and currencies will have a little bit of strengthening, which will cause the U.S. to lose a little bit of its strength from that perspective. And then the last one is the government.
The long-term effects.
Yeah, so the long-term effects, you know, you're setting up for a weaker dollar, you know, which could push down, you know, the dollar and make other countries and currencies a little bit more attractive. So, you know, it's a lot of things can happen between now and then, but I would say probably, you know, eventually, you know, the dollar is close to the top that it's ever been. So we probably at some point, just from a law of averages, we'll see that decline a little bit. You know, I don't know if that's starting later this year into next year, but then that trend will probably continue as the market finally, you know, comes back and sets new highs, and we see some stabilization in the global economy.
Thanks, Brian. That was really insightful. Another question we've been getting: do you feel the markets will retest the March 23rd lows?
It's another good question. So we honestly don't. We think that the lows that we experienced on March 23rd are the lows that we will experience for this recession that we're experiencing now. Certainly, the market has come up really fast from those lows. So we would not, you know, we think we're probably, John, going to be range bound in these levels. You know, maybe give or take 10 or 15%. From a downside perspective, because if we go up 15% from here, we're back to the February all-time highs. So that, you know, we think we probably do, you know, retest some lower levels, not to those March 23rd lows. The things we're always talking to investors about is right now there is $4.5 trillion, that's with a T, trillion dollars sitting in cash and money market. Over the last 10 years, that number's averaged more around $2 trillion and has certainly spiked here recently. So we think that if the market does experience some weakness, does decline, you know, maybe 10% from here, whatever the number would be, that there is a lot of eager buyers that are looking to buy into the equity market at lower prices, which almost would kind of create a resistance level and a floor to prevent the market from going down even further. So that is our opinion for the fact that we retest lows or not.
Yeah, we actually feel the same way. You know, while we don't feel we'll retest the lows of March 23rd, we certainly see some downside potential in the markets. But on a positive note, we do think we'll get back to February 19th. It just might take 12 to 24 months. So we're looking at more of a U-shaped recovery. Another question we've been getting. We're in that camp as well, John. I mean, and again, we know the headlines are going to be awful for the second quarter, whether you look at GDP, unemployment. But again, we always remind investors the market's moving ahead of the headlines in the news, so we think a lot of that negativity and the bad numbers is already really priced into the market. Great. And what are some areas of opportunity that you see?
Yeah, so I would say there's a few that stand out to us. Everything sold off so quickly and so fast, and it was pretty broad-based, the sell-off. But if I had to think about it from an equity perspective, we at Hartford Funds definitely see more opportunity here domestically in the U.S. markets versus international. You know, international markets have continued to lag. There's not as the coordinated monetary and fiscal policy that we have here in the U.S. Just think of the European Union, where they haven't done any really fiscal spending like we have with the CARES Act to help stabilize and try and get the economy going and kind of bridge the gap. So we definitely like the U.S. market. We also like growth companies over value companies, and think like technology, some of those names versus like financials and energy. So some of those names have certainly, we think they definitely have done better, and we think they have the ability over the next 6 to 12 months to continue to do better. And if we had to rank, large cap stocks, think your established blue chip companies, mid cap companies, small cap, we would probably rank them in that order from an opportunity perspective, at least over the next 6 to 12 months, which is really all we feel comfortable kind of trying to predict out. We think large cap will be the most established and the best winner, followed by mid cap, and then small cap probably there at the bottom. So those would be our thoughts there. And then on the fixed income side, you're still, 2 months ago, it was extremely difficult to find, income for clients, as I'm sure you were well aware of and had conversations with your clients. Now you're seeing really nice opportunities across almost every area in fixed income. So we would say investment grade corporates is probably our favorite, because you're getting twice the yield you were 2 months ago, and you're still owning a high quality bond. And you got the support of the Federal Reserve buying bonds now through some of their quantitative easing. So we definitely, as much as we like the equity opportunity, you could argue there might even be more opportunities on the fixed income side of things from a risk return standpoint.
Yeah, as far as equities, we're favoring large cap growth, especially technology and healthcare. And finally, what areas of concern do you have?
Yeah, so I would say that certainly the biggest concern is the one that's kind of the captain obvious, the 800-pound gorilla, and that's the public health, right? So just the containment of the virus, all the social distancing we've been doing, now reopening, or going through some of these phases here is, we're just, obviously it's been a human issue, and we always want to show compassion for all of us that have been, know somebody or certainly has been touched by that. But we obviously really need to be careful with how this goes, because, we do not want to experience a second wave of this where we have to go into a forced lockdown containment, which could cause a deeper, prolonged recession. So that is the top thing that we're looking at. As far as, then you run the risk, John, of like solvency risk and companies going out of business and things like that, where we're already going to have some of that. You always do in every recession, but we just don't want that number to be massive. As far as an opportunity, from an area of concern in the asset class, we would say in the shorter term, we probably would stay away from, or definitely be underweight in large cap value companies. Think banks, energy companies, financial companies, low interest rate environment, energy, obviously with us being contained and going through, the work from home, the stay-at-home orders, and all the things that we're doing with social distancing. The demand for oil has never been lower, and so the prices have just continued to fall. There will be a time when energy looks attractive. We just don't think that's, probably for at least 12 months. So some of these companies that are in that sector, even if they have strong balance sheets and they look attractive over the long term, they might really struggle to see positive returns over the next 6 to 12 months, just based on, some of their peers and just kind of being guilty by association. So we would definitely say that would be an area that we would underweight and probably transition more towards, that growth and the large cap core, large cap tech, and things like you mentioned. So we are in agreement with you and LPL and your thinking from that aspect.
Yeah, our single biggest concern is the same as yours. If we have a second wave and we need to shut the country down for a second time, certainly the equity markets will not react well. Thanks again, Brian. The information you presented today was really insightful. It truly puts in perspective the impact that different forms of media have on human psyche, especially when we're most vulnerable. Thanks to everyone who was able to join us today. We'll be posting a recording of the presentation on our website in the next couple of days. Again, the website's thecortalegroup.com. If you have any questions, about today's content, please don't hesitate to reach out to me or anyone on my team. Thanks again, and enjoy the rest of your day.
Okay, thank you.